Joining us now, Sheila Bair, former FDIC Chair and Center for Financial Stability Senior Advisor. I don't know, don't tell that to someone who wants to go get a mortgage or an auto loan or a credit card, Sheila. Why is it a good thing?
Well, I think, look, if money's free, you don't allocate it very prudently. And we've seen a lot of, bubbly conditions, a lot of silly stuff, attracting capital, a lot of consolidation, because a lot of that free money has been going into M&A. So all those things stifle innovation and ultimately hurt the economy and its ability to produce good-paying jobs. It's not done much for wages at all. It's inflated assets a lot, which helps the haves over the have-nots. So I think there's a lot for Main Street to dislike about low interest rates. Now, yeah, I'm sorry. My mortgage was 9.25% in 1990 when I first got it. So I do understand, it's all relative to what you're used for. So interest rates, mortgage rates seem high compared to this extreme aberrational, like negative real rates for mortgages for so many years, which actually fed a bubble in the housing market and has contributed mightily to home prices going up so dramatically. And credit card debt, I feel you're paying, but golly, please just pay your bill off every month. Don't pay credit card interest. Don't carry it 25% too high. Use your credit card to make payments and for convenience, but pay that off at the end of the month. And the thing is, your opportunity costs are greater now because the money if you don't spend on interest, you can put in a bank account and get 5% now. It's been so long since we could get a decent rate on our savings account. So I think this is positive for Main Street as well. It's going to be painful to get the transition, no doubt about it.
But for small businesses, Sheila, it's a very blunt instrument, raising interest rates, and the smaller, weaker firms that need to borrow get hit a lot harder, and it really does separate the winners and losers, and the bigger companies with scale that are safer have a much easier time dealing with it.
Well, I would argue that that's exactly what was going on with zero interest rate policy, and there's a lot of research on this showing that it disproportionately benefited the larger companies that could access capital markets, not so much the smaller ones that had to go for bank loans. The regional and community banks, who do the lion's share of small and medium-sized business lending, were killed by zero interest rates. You want to know why we don't have many new community banks over the past several years? If your business model is to take deposits and make loans and make money off of the NIM, it was very, very difficult. In that interest margin, it was very, very difficult to make money. So this is going to be painful to everybody to get through this. But once we go back to a more normalized environment, you're going to see more robust credit availability for the small and medium-sized businesses and less disparity between the funding costs of the large guys and the small ones.
Although I know if you chart, say, the S&P versus the Russell 2000, they traded pretty much in line until about March, when we know what happened in March. And since then, they've split, and it's the big corporates that have performed better because some argue these maturity walls are a lot more intense for smaller companies. Is that not right?
Yeah. Well, I think there's a lot of big companies that have a lot of debt resetting over the next couple of years, too. Yeah. So I'm not sure. I think there's going to be some pain for the larger ones as well. But look, this is going to be a difficult transition. But it's important to remember, historically, interest rates still aren't that high. We were in an aberrational period of zero to negative rates. We're normalizing now. There will be some pain in the transition for everybody. But when we get to the other side, this will be better for small and medium-sized businesses. It will be better for small and medium-sized banks who can then finally, we need to normalize the yield curve as well, but who can finally make a decent spread. If interest rates have hit the zero bound, it's very, very hard to make money, taking deposits and making loans. So I think, again, when we get through this, it will be a better thing, not a worse thing for Main Street.
Sheila, it's David.